Everyone knows Venice built an empire on ships and spices. Trade made them rich. Geography made them safe. That story is clean. It fits on a postcard. But wealth does not explain 300 years of dominance. Ships sink, trade routes shift, competitors arise. Venice controlled the Mediterranean from 1262 to 1560, not because they traded better. They dominated because they invented a machine that turned citizen savings into state power without destroying the economy that generated those savings. The machine was called the prestiti system. It was the world's first government bond market. Oil didn't make them powerful. It made them untouchable. Other cities had wealth. Genoa had ships. Florence had banks. But Venice engineered a financial bottleneck that let 100,000 people control a maritime empire spanning 3 continents. They built infrastructure that turned forced loans into liquid assets. They created a secondary market where debt became money. This was not capitalism. This was something upstream of capitalism, a system where the state could borrow without begging, where citizens could profit from war without fighting, where public debt became private wealth. Welcome to Histonic's Drift. We follow the money, trace the power, and expose the history they never taught you in school. Here is why this matters to you right now. Every government on Earth today uses the Venetian model. Your country borrows by selling bonds. Those bonds trade in secondary markets. Interest payments flow to bondholders. The entire architecture of sovereign debt, the $128 trillion structure holding up global finance, traces directly to a decision made in a lagoon city 762 years ago. When your government borrows, it issues bonds. When interest rates rise, bond prices fall. When central banks buy bonds, they use the Venetian playbook. You live inside the machine Venice built. In 1262, Venice faced a problem that would destroy most states. Genoa controlled Acre, the last major crusader port. Byzantine Emperor Michael VIII had just recaptured Constantinople and handed Genoa exclusive trading rights in the Black Sea. Venice's 2 most profitable trade routes were under direct threat. War was not optional. But war required ships. Ships required timber, rope, iron, and sailors. The Venetian state needed 500,000 ducats immediately. Annual tax revenue was 250,000 ducats. Standard medieval solutions existed. Raise taxes and trigger merchant revolts. Debase currency and destroy trust in your money. Borrow from foreign bankers and surrender sovereignty to creditors who could withdraw funds at any moment. Venice chose none of these. The Great Council passed a law that invented modern finance. They issued forced loans to every citizen based on wealth. Rich merchants owed thousands of ducats. Small property owners owed dozens. The loans were mandatory. Refusal meant confiscation. But here was the innovation that changed everything. The loans were transferable. You could sell your obligation to another citizen. The state promised 5% annual interest paid from customs revenue. And the state created an official market where these loans traded like commodities. They called them prestiti, government promises, the first government bonds. Within 6 months, a secondary market formed. Merchants bought and sold prestiti at the Rialto alongside pepper and silk. Prices fluctuated based on military success. Interest payments arrived quarterly. A liquid market and state debt emerged in a city of 100,000 people. This was structural genius. Venice turned a crisis into a permanent funding mechanism. They did not borrow for one war. They built machinery that could borrow forever. The evidence sits in the Archivio di Stato di Venezia. Ledgers from the Monte Vecchio, the old fund that administered prestiti from 1262 to 1482. The ledgers record every transaction, bond issuances, interest payments, secondary market sales, price fluctuations, default rates. The accounting precision is remarkable for a pre-printing press society. Frederick Lane spent decades analyzing these records. His 1973 study, Venice, a Maritime Republic, reconstructed the entire system from primary sources. Reinhold Meller's 1997 work, The Venetian Money Market, provided quantitative analysis of 200 years of bond data. Here is what the archive reveals. Between 1262 and 1300, Venice issued prestiti 47 times. Total debt reached 3.2 million ducats. Annual revenue was 750,000 ducats. The debt-to-revenue ratio was 4.3 to 1. That ratio would terrify modern economists. But Venice never defaulted. They paid 5% interest every year for 2 centuries. How? 3 mechanisms made it sustainable. First, interest came from dedicated revenue streams, customs duties on spices, grain taxes, salt monopoly profits. These were the most stable revenue sources in the Venetian economy. Bondholders had first claim. General government expenses came second. Second, bonds traded below face value. A 100 ducat prestiti might trade at 60 ducats. This created effective yields above 5%. When the state issued new bonds, they sold at market prices. Venice borrowed 100 ducats, but only received 60, but they only paid interest on 60. The discount functioned like a sinking fund. Third, the secondary market created liquidity. You could always sell. This made citizens willing to absorb massive forced loans. Coercion at issuance, freedom after, the combination worked. The Francesco Dattini archive in Prato contains merchant letters from the 1380s discussing Venetian bond purchases. Merchants treated prestiti like any other asset. They calculated yields. They traded on news. They diversified portfolios across bonds from different issuances. This was a market, not a primitive version of a market. An actual functioning bond market 500 years before Wall Street existed. Genoa tried the same thing. They failed. In 1274, 12 years after Venice launched prestiti, Genoa created the compra system, forced loans, tradable obligations, interest from dedicated revenues. But Genoa added a fatal difference. They let creditor syndicates control the revenue sources directly. When Genoa borrowed to fund a war, creditors formed a compra, a corporation that owned specific tax streams. The salt compra controlled salt taxes. The grain compra controlled grain levies. Each compra collected its own revenue and paid its own interest. This looked like decentralization. It was actually fragmentation. By 1340, Genoa had 19 separate compieri controlling different revenue streams. The state could not borrow without negotiating with each syndicate. Compieri competed for the best revenue sources. They blocked new borrowing that threatened their income. They functioned as private governments inside the state. Venice avoided this trap. The Monte Vecchio remained state-controlled. One institution, one set of ledgers, one market. Bondholders received interest, but they did not control revenue collection. The state kept the infrastructure. The distinction mattered. Genoa's system collapsed in 1407 when compieri wars turned into actual civil war. Venice's system lasted until Napoleon dissolved the Republic in 1797. Control of the machinery beats ownership of individual cash flows. Genoa gave away the system to protect specific revenue streams. Venice kept the system and managed all streams centrally. Bottlenecks create power. Fragmentation destroys it. The prestiti system gave Venice a military advantage no rival could match. When war came, Genoa, Florence, and Milan scrambled for funds. They begged bankers. They seized church silver. They debased coins. Each war triggered a financial crisis. Venice issued bonds. The War of Chioggia, 1378 to 1381, nearly destroyed Venice. Genoa blockaded the lagoon. Food supplies collapsed. The Doge considered surrender. Venice issued emergency prestiti totaling 1.8 million ducats. The bonds sold at 40% of face value. Citizens absorbed the loss because they knew they could sell later. The liquid market made coercion tolerable. Venice used the funds to build 40 new galleys in 6 months. They broke the blockade. They won the war. Bond prices recovered to 70% within 2 years. Genoa won every major battle in that war. But they ran out of money before Venice did. Financial endurance beat tactical brilliance. This pattern repeated for 200 years. Venice lost battles but won wars because their funding never stopped. The bond market was a strategic weapon. Compare this to England and France during the 100 Years' War. Both countries borrowed from Italian banks. Both depended on foreign creditors who could withdraw support. Edward III defaulted on loans from the Bardi and Peruzzi banks in 1345, destroying Florence's 2 largest financial institutions. Venice never depended on foreign credit. They borrowed from themselves. The prestiti system was a closed loop. Venetian wealth funded Venetian wars. Interest payments stayed in Venice. The money circulated inside the lagoon. This was financial sovereignty, not independence from debt, independence from foreign creditors. Modern states forgot this distinction. They think borrowing equals weakness. Venice proved that internal borrowing creates strength when you control the machinery. By 1400, Venice had refined the prestiti into a multi-layered debt structure. The Monte Vecchio held old debt from 1262 or 1350. Interest rates were 5%. These bonds traded like blue-chip securities. The Monte Nuovo, new fund, held debt from 1350, 1400. Interest rates varied from 3% to 6%, depending on military conditions. The Monte Nuovissimo, newest fund, held short-term war debt. Interest rates reached 8 to 10%. These were speculative bonds that paid off huge if Venice won. Each fund had separate ledgers, separate trading markets, separate risk profiles. Wealthy merchants bought Monte Vecchio bonds for stable income. Speculators bought Monte Nuovissimo for capital gains. Middle-class citizens held mixed portfolios. The Venetian government published bond prices monthly. They posted them at the Rialto. Price transparency created trust. Trust created liquidity. Liquidity let Venice borrow more. By 1440, total Venetian debt reached 10 million ducats. Annual revenue was 800,000 ducats. The debt-to-revenue ratio hit 12.5 to 1. That level would trigger default in most states. Venice kept paying. The secret was growth. Revenue increased 220% from 1300 to 1450. Population grew. Trade expanded. Cyprus, Crete, and parts of mainland Italy came under Venetian control. New customs posts, new tax bases, new revenue feeding the bond system. Venice structured debt to match expansion. They borrowed for conquests that generated the revenue to service the borrowing. Debt financed growth. Growth validated debt. This was the opposite of modern sovereign debt traps, where borrowing funds consumption. Venice borrowed for infrastructure, ports, shipyards, fortifications, assets that produced cash flow. When Venice borrowed 200,000 ducats to conquer Padua in 1405, they gained control of grain production that generated 40,000 ducats in annual taxes. The acquisition paid for itself in 5 years. The bond interest came from Padua's grain revenue. Every major Venetian expansion from 1350 to 1500 followed this model. Borrow, conquer, extract revenue, pay bondholders, repeat. The system was extractive, but it was sustainable extraction. Venice never killed the host. They managed territories to maximize long-term revenue. Bond markets forced fiscal discipline because default meant losing access to future borrowing. Creditors were citizens. Default meant destroying your own family's wealth. The alignment of interests worked. The Venetian prestiti died with the Republic in 1797. The system lived forever. When the Dutch founded the Amsterdam Exchange Bank in 1609, they copied Venetian bond markets. When England created the Bank of England in 1694, they studied Venetian debt management. When Alexander Hamilton structured American debt in 1790, he referenced Venetian precedents. Every modern bond market descends from the Monte Vecchio. The mechanics are identical. Governments issue bonds. Bonds pay fixed interest. Bonds trade in secondary markets. Prices fluctuate based on credit risk and interest rates. Institutional investors and central banks hold portfolios. The scale is different. Global bond markets total $128 trillion in 2024, but the architecture is Venetian. Look at how your government borrows. Treasury bonds, municipal bonds, corporate bonds, all transferable debt with fixed interest paid from dedicated revenue streams. Look at bond market infrastructure. Credit rating agencies assess default risk, like Venetian merchants assessed war news. Bond indices track prices, like Rialto postings. Central banks buy bonds to manage liquidity, like the Monte Vecchio managed prestiti supply. The language changed. The machinery did not. Here is the critical lesson Venice teaches about modern debt. Sovereign debt is sustainable when 3 conditions align. First, borrowing finances productive assets that generate revenue. Second, the state controls debt infrastructure and prevents creditor fragmentation. Third, interest payments come from stable, dedicated revenue streams. Modern states violate all 3 principles. Governments borrow to fund consumption. Social programs, current expenses, interest on previous debt. These do not generate revenue. The debt funds obligations that increase future borrowing needs. Creditors are global and fragmented. China holds U.S. bonds. Japan holds European bonds. Pension funds and hedge funds trade positions constantly. No alignment between creditor and debtor interests. Foreign bondholders can exit at any moment. Interest comes from general revenue. No dedicated streams. When revenue falls, everything competes. Bond payments fight education funding, fight military spending, fight infrastructure. The priority is political, not contractual. This is the opposite of the Venetian model. Venice borrowed for ships and fortifications, productive assets. Modern states borrow for programs that create future liabilities. Venice had captive domestic creditors whose wealth depended on state survival. Modern states have footloose global creditors who owe no loyalty. Venice dedicated customs and salt revenue exclusively to bondholders. Modern states promise nothing is senior to anything else. The result is predictable. Venetian debt was stable for 500 years. Modern sovereign debt lurches from crisis to crisis. Japan's debt to GDP ratio is 264%. Italy is 144%. The United States is 123%. These are multiples of Venetian levels. But Venice never worried about default because the system aligned incentives. Modern states ignore the machinery and wonder why debt feels unsustainable. You feel this in your life. When your government pays interest to foreign bondholders, that money leaves your economy. When interest competes with services, you get less infrastructure. When debt funds consumption instead of investment, you inherit obligations without assets. This was not inevitable. It was a choice to abandon Venetian principles. The alternative exists in history. Small states borrowing from their own citizens for productive investments, with dedicated revenue streams ensuring payment. That system worked for half a millennium. The lesson is not borrow less. The lesson is build better machinery. Venice proved that high debt works when the system is designed correctly. Creditors must depend on debtor success. Borrowing must fund growth. Revenue must flow to bondholders first. Modern economics forgot this because they studied Britain and France, states that borrowed from foreign bankers and lurched between defaults. They missed Venice, the model that worked. So when people ask, if every country is in debt, who is the creditor? The answer is visible in Venetian archives. The creditor is anyone who controls the machinery. Venice made citizens into creditors and kept infrastructure under state control. The state owed citizens. Citizens depended on state survival. The loop closed. Modern states let foreign creditors and footloose capital own the debt. The machinery fragmented. The loop broke. You live inside the broken version of a system that once worked. The Venetian Archive shows what functional sovereign debt looks like. Ledgers that balanced for 500 years. Markets that priced risk accurately. Citizens who profited from state success instead of suffering from state failure. The Monte Vecchio ledgers are not ancient history. They are the instruction manual for fixing the machinery you depend on every day. History has owners. We name them. And the owner of modern debt architecture is a city-state that disappeared 227 years ago, but still controls how your government borrows, how your bonds trade, and how your wealth flows to creditors you will never meet. Venice built the machine. You live in it. Now you know who to blame when it breaks.